Look at this chart. Gold is not just going up, it's exploding. Not in a calm, rational, markets are pricing in fundamentals kind of way, but in a something under the surface is breaking kind of way. A gold price surge that looks less like a gradual move and more like a gold momentum shift that nobody fully signed off on. Because here's the thing. Over the long arc, gold is supposed to be boring, a slow-moving precious metals rally that reacts to inflation impact, crisis cycles, and currency fear. Historically, that's been the story. Stable, predictable, almost dull. But lately, that story doesn't fit anymore. Gold is printing gold, all-time high levels, like it's ignoring the entire rulebook of macroeconomics. And when an asset class like this starts behaving differently, you don't just ask what changed in gold, you ask what changed in the world. Because something underneath is shifting, quietly and aggressively. Over the last several years, gold investment trend behavior has started breaking away from its old pattern. We're not talking about a normal asset class appreciation cycle anymore. We're talking about cross-asset inconsistency that doesn't make sense on a standard chart. Stocks are rallying, tech is euphoric, risk-on assets are pricing in a perfect future, and at the exact same time, gold is screaming the opposite message. This is not normal financial market signals alignment. This is divergence. And markets don't usually speak in two voices unless something is splitting underneath the surface. Now, the default explanation people reach for is inflation. CPI inflation trends are still part of the conversation, obviously. Cost of living increase is real. Price level increases are visible in everything from rent to groceries to energy. And yes, inflation impact absolutely matters. But here's the contradiction nobody likes to sit with. If gold was purely reacting to real versus perceived inflation, it should have reacted hard back when inflation first spiked in 2021, when monetary environment shock was at its peak, when purchasing power erosion was accelerating fast, but it didn't fully explode then. It moved. But not like this, which tells you something uncomfortable. Inflation alone is not explaining this precious metals rally. So what is? Now we move into the deeper layer, the US dollar dominance layer. For decades, the global financial system has been anchored around one assumption, that the US dollar is the global reserve currency, that foreign exchange reserves would overwhelmingly sit in dollar assets, that international trade currency flows would continue orbiting that system. But something subtle is happening now. Not a collapse, not a dramatic reset, but a slow dollar de-dollarization trend. Central banks are not announcing panic. They are adjusting allocation, quietly shifting central bank currency allocation strategies, reducing concentration risk, increasing currency diversification, and most importantly, expanding gold reserves accumulation. This is where it gets interesting, because central bank gold buying has entered a completely different regime. We are no longer talking about normal reserve diversification strategy behavior. We are talking about sustained institutional demand for gold at levels not seen in decades. Sovereign wealth strategy is being rewritten in real time. And the signal is simple. When trust in the system feels uncertain, you don't say it out loud. You hedge it. Gold becomes that hedge, not because it yields anything, but because it doesn't depend on anyone's promise. And that is the core shift. This isn't just about returns. This is about financial system trust erosion. Now zoom out and look at financial markets as a whole. We are seeing risk-on versus risk-off assets behaving like they are in different realities. Equity market rally continues upward like macroeconomic conditions are flawless. Bond market uncertainty is rising quietly underneath. And gold? Gold is acting like a macro hedging behavior instrument. Not a trade, a signal, a warning, a positioning tool for institutional risk management. This is where the contradiction becomes impossible to ignore, because asset class divergence is now extreme. On one side, markets are pricing optimism, growth, and productivity. On the other side, gold is pricing uncertainty, fragility, and long-term reserve allocation anxiety. Both cannot be fully correct at the same time. And yet, both are happening, which brings us into the uncomfortable part of the story. Trust, or more accurately, loss of confidence in fiat currency stability. This is where global financial stability concerns start creeping in, not as headlines, but as behavior, because when geopolitical risk in markets rises, even slightly, Capital doesn't scream, it moves quietly, it seeks macro hedging behavior tools. And gold has always been the simplest version of that. No counterparty risk, no default mechanism, no policy dependency, just weight and history. So when you combine systemic financial uncertainty with central banks quietly increasing gold reserves accumulation, you get a signal that is not loud, but extremely consistent. And markets are starting to notice it, which is why investor sentiment shift is becoming visible even in retail behavior, because behavioral economics tells us something simple. Humans don't react to data first, they react to narrative. And right now, the narrative versus reality in markets is breaking apart. On one side, we have official growth data. On the other, we have informational asymmetry in markets where institutions are positioning for outcomes they are not publicly explaining. That gap creates confusion. And confusion creates herd behavior in finance. People start copying signals they don't fully understand. Gold becomes one of those signals, not because everyone agrees on why, but because nobody agrees on anything else either. And that's where behavioral finance becomes the real driver. Fear versus confidence cycles are not just emotional, they are structural. When confidence is high, gold gets ignored. When confidence weakens even slightly, gold starts to wake up. And when both fear and optimism exist at the same time across different asset classes, you get exactly this kind of chart. Confusing, aggressive, and emotionally split. So what is actually going on? And it's not just inflation. It's not just rates. It's not just one macro variable. It's a layered shift. A combination of global monetary system shift, reserve currency confidence decline, central bank hedging behavior, and long-term reserve allocation changes, all happening at once, slowly, then suddenly visible. And gold is simply the asset that reflects that tension most clearly, because gold doesn't need consensus. It only needs uncertainty. And right now, uncertainty is not disappearing, it's compounding. So when you look at this gold market shock, don't just see a price chart going vertical. See what it's really showing you. A world where different parts of the financial system are no longer aligned on the same story, where equities are optimistic, bonds are cautious, and gold is quietly preparing for something more unstable than all of them want to admit. And maybe the most important takeaway isn't whether gold keeps going up, it's what it represents when it does. Because markets don't move like this when everything is fully understood. They move like this when the narrative breaks and everyone starts hedging what comes next, and right now. Gold is doing exactly that, and if you made it this far and you found this breakdown valuable, do us a favor, like the video, subscribe, and stay connected. Because we're not just watching price movements here, we're watching the story underneath the markets unfold in real time.